Hey everybody, and welcome back to Investing with Wesley. I really stress at the end of all my videos to message me on either Twitter, Facebook, Instagram, wherever, because that's where I'll answer all your guys' questions. And it's one of those questions that led to this video today. It was a very good question on should you invest in target date funds, and better yet, what are they? So in today's episode, that's exactly what we're going to be talking about today. What are target date funds? Are they worth the fees? Are they worth the hype, really? And should you invest in them? So let's get into it. Okay, so for starters, let's talk about what a target date fund is. A target date fund is usually a mutual fund, but it can also be an ETF as well. But either way, under one of those two categories, it is a fund that invests into the market between stocks and bonds and tries to get less and less risky or less and less volatile as time progresses. So how it would work is basically the target date fund will say target date fund 2060, meaning you plan on retiring in 2060. So you invest in it now, and as the money is being invested now, it should be very aggressive, or more aggressive than, let's say, 20 years from now when you're getting closer to retirement. And really, it's as simple as that. That is the goal of a target date fund, to automatically adjust your risk tolerance settings in that fund to get less and less risky and more conservative as you get closer and closer to the target date. Now, for most people, this is a huge win, which is why a lot of people put their 401k or 457 retirement money into target date funds. And simply, it's because you can kind of autopilot your investments and your savings. You throw a bunch of money into this fund, it automatically does the work adjusting it year over year, getting more and more conservative, and you really don't have to worry about it. It truly is autopilot. But just because there's that one big pro doesn't mean that it outweighs all the cons. As an example, like I said, it's mostly found in mutual funds, and these funds have an extremely high fee. Mutual fund sales load range anywhere from 5 to 8% right off the top. So no matter what, every time you give this fund money, 5 to 8% of that money you give it gets wiped away to the sales fee right out the gate. And even comparing the ETF option, because ETFs are always cheaper than mutual funds, it's an actively traded fund because it's a target date fund, which means whether it's a mutual fund or an ETF, it'll still be very expensive in fees because of the active management of those funds. And this isn't really a pro or a con, it's more just anecdotal evidence. Between a bunch of different target date funds that I've found, they really don't perform as you think they would. Within the first couple of years, you'd think they'd be very aggressive, all in equities, and thus kind of mirror the stock market, but in all the ones I've found, they really don't. In fact, they're even way more conservative than the Vanguard Balance Index that a lot of people use to balance their portfolios with. So I have a couple different charts that I want to show you guys, and I'll put them on screen now, starting with the list of target date funds I've found. Now, in the comparisons, we're going to be using the 10-year return, and you'll see all of these target date funds don't have a 10-year, and that's because technically they haven't reached their 10th year yet. All of these target date funds were founded in 2014, so almost 10 years, but not quite 10 years yet. You can see that the latest target date fund, the one with the absolute most time horizon, has barely been getting any percentages at all. And between all of them, we're looking at an average of what, 6-ish%. Now, if we go to the S&P 500 or the chart showing SPY's 10-year, we're looking at 12+%. Now, obviously, a target date fund should only mirror the US stock market for so long before it starts to get less and less risky and less volatile. But even then, there is no target date fund in any of these categories that matches the S&P 500. And like I mentioned earlier with Vanguard's Balance Index, if we pull up the chart of the Vanguard Balance Index, VBIAX, we'll see that over the past 10 years, it's averaged 8+%. It still doesn't even match up. Why pay the heavy fee, whether it's a mutual fund or ETF, of this target date fund when I could start off paying virtually 0% sales load by investing in the S&P 500 and then switching it less and less from the S&P 500 towards the balance index more and more as time progresses, making it more and more safe. I could do that myself using just these two ETFs and save all the sales load and theoretically get better returns than if I just used the target date fund. Really, the only downside is that I have to do the legwork and the investing and the switching myself as opposed to having someone do it for me. But if I have someone do it for me, I have to pay them for the effort and the sales fee, and I won't even get as good of a return as if I did it myself. So based on what I've researched, what I've found, and what I've looked at, I don't think target date funds are really worth the hype at all. I think they're one of those products that Wall Street created and invented to entice a lot of people in to make something really easy to sell, so that the agents and reps in charge of selling you these products can have something new to sell and potentially make a lot of money doing it. But as far as if it's worth putting in your portfolio and worth investing in, not based on everything I've seen. And something I just thought to talk to you guys about right now, because I know someone's going to have a question about it. What about the taxes? Well, in an actively managed fund like a target date fund, you can't really pick when the advisor that's managing that fund is going to buy and sell certain stocks or bonds in that fund. So they could sell something in the fund and then pass through the taxes right onto you. So it's really not that tax efficient. Now, granted, it's mostly meant for retirement accounts. So if you're investing in something like a Roth, then the taxes wouldn't really matter. That's still something you need to consider if you're not in a Roth IRA or a Roth 401k. If you are subject to taxes, then the taxes you're going to want to pay attention to. Versus if you did everything yourself, then you could wait until 365 plus 1 days later, where it would go into long-term gains, sell your gains, buy your lows, and really customize when you buy and sell to be more tax beneficial. Again, guys, if you have any questions, comments, or just want something addressed, feel free to message me. I have a Facebook, Instagram, Twitter, and now a TikTok that you'll probably be seeing this video on. So feel free to comment or message me there. But either way, the choice is yours, and I'll see you in the next episode.